Welcome to the Jupiter Joe Money Show. I'm Jenny Thomas, and we have Jupiter Joe, our host.
That's right.
And today we're talking about CDs and how annuities beat the banks.
Yeah, I wrote an article a long time ago called Beat the Banks. And what I meant by that was that, annuities, fixed annuities, it's a specific type of annuity, fixed annuity, very similar to a CD, but it's at an insurance company instead of a bank. And we can beat the rates. Generally, we're going to be 1.5 to 2 points higher in most cases. Some cases more. Just depends.
Right. So there's a lot of differences. There's similarities and there's differences.
Yep.
And I think what I've found is that the differences is actually making more money with a fixed annuity with comparing it to a CD.
Absolutely. If you're going to hold an annuity for, say, 3 to 5 years and you're getting 2% more, it's a lot more interest. 2% a year on 100 grand is 2,000 times 5 years is 10,000. That's without the compounding of interest. And we're going to talk about tax deferral. Some people don't get tax deferral. I'll have an easy way to explain it once we get into that.
Right. So what should we do? Should we dive into some of the biggest disadvantages of CDs?
No, I think we should talk about rates. Because people listening want to know about interest rates. And right now, people have been on a high with interest rates, high yield savings, high yield CDs. Well, that's going to change rapidly. I've been talking about it. People get ready because interest rates are going to be back down to 2%, maybe 1% again at your bank. Well, how's that going to happen, Joe? Well, President Trump has put a new chairman in there, he's getting rid of Powell, and once he's gone, and this new gentleman, I think his name is Mash, whatever his name is, he's going to go in and he's going to lower interest rates. And that means it's good for if you're borrowing money at a bank for a house, but it's going to be terrible for somebody that's got a CD, a high yield savings account will be low yield. It's the way it's going to be. But right now, why I'm telling you this is because you can lock in your rate to a higher rate in the fives. You're going to talk about some CD rates. What are the current CD rates? I didn't look them up, but I know generally what they are. They're in the 3% range.
3 to 4.
Right.
4 is basically the highest I've found.
Right.
3.90, 4%.
Yep. And it's a teaser rate. A lot of these 4%ers are a 6-month CD, or there's one on a local channel here where they advertise, 5% for 5 months. And that rate has actually come down to like 3.50 or something for 5 months. And then what they do after that, they don't give you any interest. You've got to renew it or invest it in the market. That's what they really want to do. That's why they give you a teaser rate. So if you're not constantly on it, you're going to get less interest, or you're going to get no interest. One of our clients came in, put like $500,000 in one of these teaser rates, and he got 6 months at like 5.25%. And then he left it in there and he didn't do anything with it. And he went in the girl, he said, "Oh, here's your interest." And he couldn't believe it was half of what he thought. She said, "Well, you only got interest for 6 months. The other 6 months you didn't earn any interest."
Wow.
And he was so mad. And of course he invested with us because he realized that our rates are for 1 year at a time. You can invest for 1 year, 2 years, 3 years, all the way up to 10 years. People don't understand that you can pick an interest rate for the length of time you want. You choose what you want when you do one of these fixed annuities. And that's what we're specialists at. I tell people, we have 48 to 50 pages of fixed rates.
Yep.
That means we're competitive. We're going to beat anybody out there. We're going to beat your bank. We're going to beat the pants off them. Okay? Go ahead, Jenny.
So when they might have a CD that's renewing soon. So when you're talking about locking in the rate, you're locking in a specific rate for a specific period of time.
Yep.
And that rate doesn't change. It's a guaranteed rate.
Right. It does not change. So if you take let's use the sweet spot. The sweet spot in these annuities, fixed annuities, is going to be 3 years or 5 years. So you're only in it for 3 years. So let's say you pick a 36-month annuity, fixed annuity. The rate's going to be about 5.25%, just rough number. It's going to vary. Disclosure, the rates are going to be determined when you actually purchase the annuity at that specific time. The rates vary. Our rates are still up there, but you're going to lock into a 5.25% rate for 3 years. At the end of 3 years, you have three things you can do. You can renew it with the new rate they give you, just like you would with a CD. You can take all your money, walk away clean, no fee, no charge. Or I'm going to call you, or Jenny's going to call you and say, "Hey, guess what? We beat that rate, and we can get you a better rate." So we're there for you. We're going to hold your hand all the way through this. It's not going to, we're going to be on the case, so to speak,
Right. So if you have questions for Joe and want to hear what our rates are for your specific lump sum, give Jupiter Joe a call, 561-743-0999, or you can easily go to our website, jupiterjoe.com, and book your free appointment.
And make sure you guys, if you're listening, I would greatly appreciate if you would subscribe to our YouTube channel. We're a newbie. A newbie but an oldie kind of thing. We've been doing it for a while, but we just started this channel, and I would appreciate anybody out there to subscribe and kind of get our listenership going here. I want to talk about one thing, and this is, when you talk about insurance companies, sometimes there's this mystic view of insurance companies. But let me tell you something. The bank building and the insurance building look exactly the same. I don't know if you've ever driven through Jacksonville. You see the big insurance company buildings up there. Well, or you go to Miami or you go anywhere. There are usually the bank buildings and the insurance building. They look exactly the same because they all have major assets. They just work differently. And some things an insurance company can do and some things a bank can't do, and vice versa. So just understand that it's just a different type of investment than you're used to. That's all.
Exactly. I think a lot of people don't understand that. It's like when I went to Iowa, Des Moines,
Iowa.
Des Moines.
Yeah.
There's so many insurance companies there.
Oh my
and
God,
let me tell you, they are the nicest people over there.
Yeah, they're the capital of insurance companies, Des Moines, Iowa. Yeah, more insurance companies there than anywhere. And I guess they go out there as probably some kind of tax benefit, but they've infiltrated that area tremendously.
Exactly.
So
for tax-deferred growth, when you have a non-qualified CD and you have a non-qualified fixed annuity,
right?
What I found is that there's a big difference for how much money you're actually earning when you compare the two.
Yes.
Because you're not paying the taxes you would pay on the CD. So your interest is being compounded.
Right. Compounded daily interest. By the way, it's compounded daily, not yearly. That means you're earning interest on your interest every day. And we can tell you to the penny how much you're going to earn per year. And let's talk about this. You can take your interest monthly, starting immediately within 30 days. And then you can take that interest for a year, 2 years, 3 years, whatever time frame you'd like. And then you can stop it if you want. And you can continue it if you want it. You're in control of your money. The biggest disadvantage to buying an annuity is that you're locked in for that 3-year or 5-year period, versus a CD where they have an early withdrawal penalty, but with an insurance product, you're going to have a surrender charge. So it sounds scary, surrender charge. Well, if you don't cash it in early, you're never going to have a fee or a charge.
Right.
Never. And how do I get paid? I get a commission based on how much money you're putting in for the length of time you're purchasing and depending on the product. And we're going to explain all that to you when you see us in person. The biggest problem with the annuities versus the CDs is that you have a surrender charge. And I'm only repeating this because I want to make sure, full disclosure out there, don't cash it in early. You'll never have a fee, never have a charge. Now, the problem with people out there listening is that they bundle all this stuff up. Annuities, oh my God, bad news. Well, there's different annuities,
Right.
And they do different things. And we're here to explain how they work. They are complicated vehicles, meaning that's an investment vehicle, and you got to know how it works. And that's what we specialize in. We're going to make it as simple as we can. You remember Jeff Foxworthy? He did a show. I can't remember what it was. I'm smarter than, or you're smarter than a fifth grader or something.
Yeah.
Whatever it was, third grader. And I'm probably not, because I watched that show and those kids were much smarter than I was. But when I explain this stuff to people, I've got to explain it to them like they're a third grader or a fifth grader, so they get it. And not everybody does. I heard a commercial a long time ago, and the guy said, look, if you can't get past the word annuity, you got a problem. This is just another tool in your toolbox for your retirement. It's a great way to accumulate wealth. It's a great way to avoid or reduce taxes. Avoid probate. I have a lot of senior clients over the years down in South Florida here, and a lot of them want to, eliminate probate. Well, in Florida, guess what? An annuity is not probatable. That means you don't pay 5, 6, or maybe as high as 10% probate tax to the government. That's a big deal. If you leave your money not in a trust, basically you're going to, and look, we're not experts in trusts or wills or that sort of thing. That's a legal thing. You go to an attorney for that. But we do know about what we do with this. It avoids probate. All annuities do in the state of Florida.
So that's a big difference. So you're not disinheriting.
You're not disinheriting anybody. The other thing it has creditor protection. So if you're being sued, if you hit somebody and they decide to sue you, they can't attach that money. Nobody knows about the annuity except you, me, and the insurance company. And nobody's getting it except your beneficiary. What people have to understand here, this tax deferral thing, you can keep it going as long as you want. So if you're 55 years of age, I'm using this for a reason, and you're not going to need the money for 10 years, why are you going to pay tax for 10 years on money you're not using? Right. That's where people make a big mistake. So if they put their money in an annuity that they don't touch for 10 years, they don't pay any tax for 10 years. That means you have more money. You have money on your money that you would have paid taxes on.
Yes.
It's a concept that's kind of hard for people to understand, tax deferral. But here's an example. Remember I told you I was going to give you an example. You have your 401k. You add money to it all these years, 20 years, 30 years of 401k contributions. It's tax deferred. The same exact deferral tax code that you have with an annuity is in your 401k. It's tax deferred until you take it. When you take it, it's taxable. Same thing with an annuity. The longer you defer, the more money you have because you're accumulating money on your money and you're not paying tax on it.
Right, exactly.
It is a very big deal, this tax deferral thing. I had one person tell me it's not a big deal. I said, really? I said, let me show you what you just did. And they said, okay, where do I sign?
Because it makes sense.
It does make sense once you understand the numbers. It's, you got to break down things very simply. And I'm a simple guy in many respects. And here's what I say to people. Look, I can do two things for you right now. I can give, if we take this 200,000, I can give you, you can get 250,000 in the future and you pay tax on the 50 grand, right? So you put in 200, it's now worth 250 in 5 years with a CD and you pay tax on that 50 grand. You'll end up with 240. Right. You made 40,000. Or I can give you 300,000 in the future, okay? And you pay no tax on it. And guess what? You can keep rolling it for another 5 or 10 years if you want to, and you never pay the tax until you need to pay it. Now, here's the bad thing. One bad thing is that the money will go to your beneficiary and it will be taxed to the beneficiary, okay? We have ways around that. We have products that actually will leave more money to the beneficiary. There's some products that we have that do that. Or we'll tell you that you can use it as income at some point, and then spend down the money or pay the kids over a period of time, 10 years, spread the tax out. So these are concepts that we do with our clients to make sure that you understand that it's just not buying an annuity. The show is not built on buying annuities. It's based on information and education about your retirement plans, Social Security, reducing taxes, estate planning, protecting your money. Listen, you don't have to be a billionaire out there to protect your money. Everybody can do it. You can do it with a trust. You can do it with an annuity. Well, it's free. When we give you your book and your information, it's free. Nothing wrong with that.
Go to jupiterjoe.com, book your free appointment now, get a second opinion. Give us a call, 561-743-0999. This is a Jupiter Joe Money Show, and we'll catch you next time.
Thank you.